Understanding liquidity crises, causes, consequences, and mitigation strategies. A liquidity crisis is a significant financial occurrence that usually spells trouble not just for individual businesses but also for entire economies. Characterized by a simultaneous shortage of cash or cash-equivalent assets, assets that can be quickly converted into cash, a liquidity crisis can create a perfect storm of financial instability. What is a liquidity crisis? In simple terms, a liquidity crisis arises when financial institutions and businesses find themselves unable to meet their short-term obligations due to a lack of available cash. This situation often leads to a vicious cycle of increasing demand and diminishing supply of liquidity, ultimately causing many institutions to default on their obligations or even face bankruptcy. Key takeaways. A liquidity crisis involves a simultaneous increase in demand for liquidity and a decrease in its supply across various entities. The root causes often stem from maturity mismatching between assets and liabilities of financial institutions and businesses. Liquidity crises can be triggered either by significant economic shocks or by cyclical changes in economic conditions. Understanding the mechanics of a liquidity crisis. The need for liquidity in financial systems originates from the timing mismatches between when obligations are due for payment and when anticipated cash inflows will be received. If businesses miscalculate their cash flow needs, they may find themselves unable to meet obligations even if they possess substantial total assets. Single business liquidity problems. For individual companies, a lack of liquid assets to satisfy short-term obligations, like paying vendors, employees, or repaying loans, can lead to dire consequences. A business might have a viable long-term model, yet if it mismanages its cash flow, it faces the risk of default or bankruptcy. Maturity mismatching. This fundamental issue occurs when the duration of a business's liabilities, debts, does not correspond with the duration of its assets, income streams. For example, if a firm relies on long-term investments, expecting slow but steady revenue, but incurs short-term debts that require immediate repayment, a cash flow mismatch can arise. Cash flow issues. If anticipated revenues from projects do not materialize in a timely manner, the business may find itself unable to cover operational costs, leading to default. Many businesses typically manage their liquidity by maintaining a buffer of cash or liquid assets, seeking short-term financing, or structuring their assets and liabilities to align in maturity. If these measures fail, companies may resort to liquidating long-term investments, which is often a sign of serious distress. Vulnerabilities of financial institutions. Banks are particularly susceptible to liquidity crises due to their unique operating models. They typically borrow short-term from depositors and lend long-term through mortgages and other loans. Maturity mismatching is not just common, it is central to their operations. When multiple banks face simultaneous liquidity shortages, the situation can exacerbate into a broader liquidity crisis. Rapid withdrawals by depositors, often driven by fear or uncertainty, can create a banking crisis as financial institutions scramble to maintain solvency. The broader economic impact of a liquidity crisis. When a liquidity crisis engulfs the financial system, the consequences are far-reaching. Interest rates often escalate, and the value of assets can plummet as numerous institutions attempt to offload assets simultaneously. The economic ripple effect impacts not only the institutions involved but also the businesses reliant on financial services and loans. Implications. Banking segments. In times of crisis, banks often tighten credit, meaning loan approvals decline sharply. As a result, many businesses struggle to maintain operations. Impact on employment. A trickle-down effect ensues, where the lack of operational funds for businesses leads to layoffs and reduced consumer spending. Economic slowdowns. The inherent instability created by a liquidity crisis can lead to full-blown economic recessions, preventing economic recovery for an extended period. Historical context. The Great Recession. The Great Recession serves as a classic example of a liquidity crisis born from systemic issues within the banking sector. The practice of banks financing long-term loans with short-term borrowings meant that they were extremely vulnerable to shifts in market conditions. When the housing market collapsed and interest rates increased, many institutions could not secure the necessary liquidity to cover their debts, leading to widespread failures. Conclusion: mitigating liquidity crises. Understanding the mechanics and symptoms of a liquidity crisis can provide essential insights into mitigating risks. Various strategies can be employed, including 1. Improved cash flow management. Businesses should monitor their cash flows meticulously and align their investments and liabilities efficiently. 2. Diversification of revenue streams. By having multiple reliable income sources, businesses can shield themselves from downturns in specific markets. 3. Establishing emergency liquidity reserves. Holding cash reserves can act as a buffer during economic downturns. 4. Regulatory oversight. For financial institutions, robust regulatory frameworks are crucial in ensuring that banks maintain reserve ratios that can help alleviate liquidity pressures during a crisis. In conclusion, a liquidity crisis can destabilize economies and wreak havoc on financial systems. Awareness and proactive measures play defining roles in mitigating risks associated with this perilous phenomenon.